Good afternoon, everyone. Welcome to NEN webinar. My name is Meenakshi, and on behalf of NEN and Wadhwani Foundation, I would like to invite you all for this webinar and also introduce our expert speaker, Ms. Radhika Meenakshi Shankar. She is the founder of Wise Owl Consulting Services, Hyderabad. Professor Radhika Meenakshi Shankar is actively involved in the industry circles and academic campuses promoting entrepreneurship and incubation, mentoring startups, and providing consultancy for existing MSMEs through her management service firm for MSME at Hyderabad. Wise Owl Consulting Services since 2011. Her enterprise focuses on training entrepreneurs, trainers, facilities, students. She has to her credit of training more than 1,000 potential and existing entrepreneurs across India. She has and is mentoring startups and is a registered mentor with many reputed institutions. Professor Radhika Shankar also has 20 years of academic experience in teaching finance and entrepreneurship at reputed institutes across India. Today, she will share her experiences of having worked with ventures and entrepreneurs of different sizes, right from an early stage startup to growth stage to mature PE-backed companies with all the attendees. Before I hand over the floor to Radhika ji, here are a few reminders for the audience. You will be on mute. You may ask a question by typing in the panel provided. Over to you, Radhika ji.
Hello, I'm Radhika here. It's a great pleasure to be facilitating today. Hello, and let's talk about cash. Cash, duddu, paisa, dambudi, kasu, rupaya, dough. There are so many words, but it is a very universally understood word. And it is one of the most basic important input to run your business. Be it a startup, be it a growth firm, be it a maturing firm, or be it in the last stages of a firm. At all stages, the cash becomes a very important input for an organization. When I talk about cash in relationship with business enterprises today, I mean obviously the coins, the notes, your balance in the bank, and your short-term securities, which can be converted to cash within a couple of days, not even a couple of days, a couple of hours. In a world where cash is a king, it's very mandatory that all entrepreneurs learn to efficiently manage their cash flows. So what is cash flow? Movement of cash into or from outside into the firm, or from the firm outside, or within the firm itself is referred to the various cash flows. These could be inflows or it could be outflows. The most important thing is the quantum of these flows, the timings of these flows. These are the two important features of the flows that has to be kept in mind because they impact the enterprise. Now, whenever you look at an ideal situation is your inflows and your outflows match. That's a very idealistic situation. But practically, this never happens. So hence, therefore, there would always be a scene where your outflows would be in more than your inflows, or your inflows will be more than your outflows. When inflows are more than your outflows, we have a surplus and we are sitting on a very sweet spot. Well, let's not talk about that sweet spot because that rarely happens. But where we are talking about when the outflows increase or is more than your inflows, then there is bound to be a gap. Now this gap or a shortfall or a deficit as you can call can be for a very short time period, could be for a medium time period. And sometimes in the gap widens and keeps on widening, then you face what normally entrepreneur faces, which is called as severe cash crunch or liquidity crunch. And believe me, this cash crunch can happen not only for a startup, but also for a very high growth profit making enterprise. You may suddenly find that you're having so much of sales happening. I have so many entrepreneurs who come to me and say, "Man, I'm having sales. I have orders all over the place. But where is the cash? There is no cash to finance this. There is no cash to actually take this deal and see it through. Why does this happen?" That is because as an entrepreneur, we are not very, very highly aware of how to manage cash. So that is why it's very important that we understand, plan for the cash flows, and know all our optimum levels, and therefore manage our cash very well. Now, when you want to synergize your inflows and outflows, it is very important that you understand, first of all, what are the challenges. Now, when you look at the cash flow itself, you bring in your cash, right? And when you bring in your cash to start your business, there are two important ways the flows occurs, the outflows especially. The outflows happen, for example, in capex or capital expenditure, and some of the expenses happen in operating levels. So you have the OPEX. So when you look at the quantum of money that you bring in as cash, now if this could be inflows in terms of financing, you could have brought in either as your equity, your own money, or borrowed or whatever. You could also have borrowed for loans, okay, so you have a debt. So it could be in equity or in debt, and these will be brought in, and together you need to look at the expenditure of your business, whether it is the capital expenditure or your operating expenditure. Now, invariably, the operating expenses or the working capital requirements, as it is called, a very small portion of it can be financed with the long-term assets or long-term money that you bring in. On the other hand, it's preferable that you finance your operating expenses or your day-to-day working capital expenses from cash generated through your operations. So therefore, most of the cash flows occur and need the concentration should be more on your OPEX or your operating expenses. In case of CAPEX or your capital expenditure, the cash flow happens once in a way. The amount of cash that goes out is very huge, but the flow is known, and you do a whole lot of checking on it, like your capital budgeting exercises before you buy your long-term assets. Whereas in case of repetitive operating expenses, there are some expenses which are repetitive and which are fixed. For example, your rent, your salaries, etc. These are all fixed and they are periodic. Whereas there are some other expenses which can unexpectedly occur in your operations. Purchasing of raw materials, etc. are all expenses which are variable in relation to the volume. So you have both your fixed costs and your variable costs all coming as a part of your OPEX. Now, cash inflows and cash outflows in terms of CAPEX and OPEX, the quantum is what we need to look at. The second important challenge that you have while we look at the cash flow management itself is the timing. Sometimes the timings are very, very predictable. Like, for example, you know when you have to pay your taxes or your insurance premium, so on and so forth. And there are some expenses which come suddenly. Now, your revenue too could be, your inflows we are talking about, could be sudden, could be periodic, could be sporadic, or could be seasonal. So the timings of your inflows and your outflows. Some of your flows could be long-term, some of them could be short-term. So the timings play a very important role. The amount and the timings is the next important challenge that you face while doing how do I manage cash effectively. There are two important challenges. The first two are the most important one. The amount or the quantum of money or cash that's going to flow, and the timings on when it's going to flow and how long it's going to stay on with you. Now, another important challenge is how prepared are you to meet these gaps? Are you prepared to meet the small gap that falls between, let's say, your outflows and your inflows? When your outflows increase your inflows, there is a deficit. Now, for the short-term deficit, 1 month or 2 months, do you have any source from where you can take money and fill in the gap? Please identify these sources. It's very, very, one of the most challenging thing is, where do I go for money for 1 month? And next month I'm going to get this money. Where will I put this money? How do I meet this gap? So always have a very good small kitty savings bank. I mean, it's very idealistic and we all know that all our savings are always used. But to keep an emergency cash kitty is something which you should always be prepared as an entrepreneur. And when you have surplus, you should also be prepared in the sense, where do I invest it safely to make more money? Then where can I invest it such that I get the money when I want? Because you cannot lose out opportunities. And therefore, if you're sitting on money, and then if you're going to lose out on opportunities simply because you got it locked in investments which cannot be taken out, that's when your management goes for a toss. Another important challenge is, how do you evaluate and know your optimum cash levels? How much cash should I have in my hand? Now this is a perennial question. If you have too much cash, then you are said, "Arey, you don't know how to rotate cash, your cash is lying idle, you're not using cash efficiently." On the other hand, if you fall short of cash, then you're losing out opportunities, you're not able to pay your dues on time, and you lose your face in the market. So how do you know, or how do you evaluate what is the correct level of cash that I should have? Are there means, are there tools to know how can I keep cash at the correct optimum levels? Yes, there are. And yes, all these levels depend on what your nature of your business, the seasonality of your business, and so on and so forth. The next important challenges that you can have is the predictability that I've already told you. You may predict that the cash is going to come and that your customer to whom you have given 30 days credit will promptly pay on 30th day evening or anything, you know. We predict that way and hopefully and start building all our cash plans based on predicting that things will happen well in an optimistic way. But it's not so often what we predict really happens. So we have to be prepared for the sudden changes in what we have predicted or the gap in our forecasts, etc. So however much you may predict your cash budget, however much you may predict your inflows and outflows, the element of risk is in the fact that what you predict may or may not happen. And last but not the least, one of the most important challenges in cash flow management is, how do you control the vagaries in what you plan and what actually happens in reality? Now, you may have a budget and you may put in and predict your cash flow statements and say, these are going to be my flows in future, but what actually flows in and what you have actually predicted, this difference, how do you take corrective steps to control it? So these are some of the things, challenges that as entrepreneurs you face while you have a cash flow management, practicing good cash flow management. To understand cash flow management much better, it's also important that you understand the cash flow cycle. How does the cash that comes into your business flows into your raw materials, then flows into your semi-finished goods, and then gets to become your finished goods? Now, at finished goods, you can either sell it for cash and get back the cash, or when you sell it on credit, it then gets converted to your trade debtors or accounts receivable, as it is called. And then from there on, till your debtors or your trade receivables pay the money, then it gets converted into cash. In between this whole cycle, there is also a place where you buy raw materials and you receive credit period from your vendors. So that much of the vendor's cash gets locked in your system, so you have that much leeway. So your cash gets locked from the time the cash goes out to pay your raw materials to the time the cash comes in from your finished goods. Whether it is payment from finished goods, direct cash sales, or payment from your debtors, up to this is your cash period or lock-in period of your cash. And there is also a lock-key there which you get by a leeway which you get from your creditors or your vendors, trade creditors or your vendors, who give you a certain X number of days to pay your bills. So this also should be kept. So the operating cash cycle is what we're going to talk about next. Before that, I would like to just talk a little bit more on a very important aspect which a lot of people get confused with. Are profit-making companies cash-rich companies? Now, Narayan Murthy of Infosys has very rightly put, profit is an opinion, but cash is a fact. Because cash you can count. Profit is an opinion because each time you can have cash profit before tax, after tax, You can, you can manipulate profits in your books of accounts. But cash cannot be manipulated because you can count it and actually face it. Now, this is something which we as entrepreneurs have to remember very, very, very carefully. That your financial statements may show great profit, but you may find that your cash coffers or your boxes and your desks where you keep your cash is actually becoming more and more empty. Why is that happening? You are on a fast growth trajectory. Usually for startups this becomes a problem because in the beginning when you start up, there's a lot of burn rate wherein you have a lot of expenses and you have to set up your infrastructure. So there's a lot of cash going out in capex. But when it comes to OPEX, there's not much of revenues happening and you still have to meet your fixed expenses. And therefore for startups, there's a little bit of abnormal flows that happen in the beginning till you stabilize. So that we have to be aware. We'll talk about it in a little while from now. But I'm going to talk a little bit now about growth enterprises and how they are on a fast trajectory to growth, because once you find that you have a fantastic product and your sales is happening and you've done so much and suddenly you find that your company is galloping, your sales is growing, but you don't have the wherewithal to meet the sales. You suddenly find that there is no cash for which you have to make your products and sell it. This is one of the most important things. You can find, I have a lot of entrepreneurs who come and tell me, okay, what's your biggest problem is, I'm having collection as my problem, you see. And you see that I'm getting more and more orders, but the collections is going a little sluggish, and therefore I don't have money to meet the new orders. And then I have entrepreneurs who come and tell me, ma'am, I'm getting orders, but those people have to give me cash to even, make sure that this new order of theirs gets fulfilled. But they keep saying, "Arey, fulfill this, take this order, no, take 2 more orders, no." But they don't give me cash. How do I then service this order? Now, this is very, very common in MSMEs. And of course, if you are in the big brother syndrome, as they call it, that is when you have a really one of the big customers, those big fish that you net in and who actually can breathe life into your business and you grow up, you call them the big brother. They normally pile you with orders, but and they give you some amount to even start off with, but over a period of time they keep piling you with orders, but you don't have money to service these orders and you don't have the time to look at new customers, so you're caught up in the cycle. And most of the time the government therefore has now come up with, you can charge your customers for non-payment on time some certain percentage of interest. But who in the right mind will go talk to your biggest customer and say, "Hey boss, please give me interest on this outstanding dues, otherwise I'm not going to service your orders." It's like suicide. So therefore it's a very catch-22 situation, and that is what you should not fall into. It's good to have a big brother pulling you up, but you should also make it a point that you look at other customers also, so that you don't fall into this cash crunch. And therefore, your financial statements, your trading profit and loss and balance sheet could be showing high growth, high revenues, and should be showing high levels of profits, but your cash levels may not be the same. So this is something that is mandatory, that every entrepreneur understands, that just because your sales are increasing doesn't mean your cash is increasing. Now, once that is understood, the plus point is that if you're growing, then you can understand that there is going to be a positive cash flow in future. How can you make that synchronized with your current present and therefore have an efficient cash flow system in place? Now, many of the time you will see that as a part of your financial statements, either when you're pitching for funds or you're giving your business plan or report to the banks or pitching to things, VCs, you would be looking at your strategic investors. You would look at, they would be asking you for financial statements and projected trading profit and loss accounts for the next 3-4 years, and also the cash flow statement for the next 1 year. Now, that is where we need to be very, very thorough on, is our cash flow statement. So I will be talking a little while from now about what is the cash flow statement and what does it entail and what are the important things that need to be looked for in this cash flow statement a little while from now. But I'm going next to the most important thing that I was talking to you about is the cash operating cycle that we talked about, wherein it's very clearly given that the duration of operating cash cycle is the days of holding inventory and the days of holding your accounts receivable. The total number of days from this bar to this bar, that is your total gross operating cash cycle, minus the cash that is tied up of the vendors which you pay. If you would deduct that, what you get is your net operating cash cycle. Now, as entrepreneurs, you should be very aware of this operating cash cycles. How many days does my inventory stay in as inventory till it becomes debtors or it becomes cash? How many days does my debtor or my accounts receivable remain as collectibles and get converted into cash? So days it takes to convert them into cash is very, very important. This is the first thing that you should know about your business. Now, this is much easier for a manufacturing company. But when you look at a service-oriented company, there's not much of inventory that you're talking about. And therefore, only the accounts receivable, that will be your operating cycle where your cash gets locked up. But in a service industry, it's very important for us to understand that building the infrastructure, the capex part of it, the capitalized part of it, is much more. For example, if you're an IT company building a platform on which the e-commerce should happen or whatever, so those sort of things are all capex, and the developmental cost, etc., the burn rate that happens while building. For 1 year, you're not having sales, you're only building product. The entire thing becomes a capital cost for you. So therefore, once you start lending, let's say you go and take this platform and give it to a company and they give you rent every month, or they can buy off the platform itself or buy the software package and install it, and you give them 30 days credit. So those sort of things can happen. That will be your operating cash that side. This will be more of your capex. Okay. So let us now go to understanding the very important cash flow statement which goes along with your other financial statements. So cash flow statement is mandatory nowadays for all enterprises. If you are a startup, you need to project your cash flow statement for the next 1 year. Whether you're a growth firm or whether you're a mature firm, you need to show your cash flow statements. So there is a particular format in which these cash flow statements have to be prepared. That is recognized by law. So the statement which shows your cash inflows and outflows for a particular period under 3 main activities of an enterprise. So the entire cash flow statement is divided into 3 activities. So you have the investing activity, inflows, outflows, financial activities, inflows, outflows, and operating activities, inflows and outflows. Now this is what the cash flow statement captures for a particular period. The period could be weekly, monthly, quarterly, semi-annual, annual, but whatever the case may be. Very clearly, the inflows and outflows need to be captured for that time period under these 3 headings. So let us see what these headings are. First, let's take investing activities. When I talk about investing activities, we are talking about putting your cash in capex, your capital expenditure. So your inflows is when you purchase an asset, you buy a plant, machinery, etc. Remember, the cash flow statement talks both about capex as well as opex, right? So when you're talking about investment here, we are talking more and more about capex, and we're talking about how much of assets have we purchased, which is your outflows of cash. And if you have sold any asset that particular period, then there is an inflow of cash. So all assets purchases will be outflows, and the sale of assets would come under the investing activities, inflows and outflows. When you take the other activity, which is called financing activities, here we are talking about sources from where we have raised money for the business. Now, raising money for business could be through debt and equity, as I earlier said. Now, in financing activities, we talk about inflows of cash that has come into the business by raising money. Now, cash could come in either by way of the equity bringing by the owners, or it could come by way of a bank loan or debt, money coming in. Any which ways, cash flowing in terms of either debt or equity come under financing activities. Similarly, repayment of debt, repayment of your loans, all these things come as outflows under financing activities. So inflows and outflows through financial activities where you raise money for the business or repay back the money that you have borrowed, all these things come under financing activities, inflows and outflows. Now, when it comes to operating activities, here we talk about all cash inflows and outflows that happen in the operating side. So all your administrative expenses, your office expenses, your selling expenses, your marketing expenses, so on and so forth are all outflows. You may get income from deposits, you may get income from investing in short-term thing, you may get commissions, all this as a company. So all those revenues or etc. will all be the inflows, and the other thing will be the outflows. All your expenses would be the outflows. So net result is, in your cash flow statement, very clearly you will write the inflows and outflows during the period for investing activities, for financing activities and operating activities. The net result added with your opening balance of cash and to these inflows and outflows would definitely result in your closing balance of cash. This can be clearly verified. So the cash flow statement therefore is very, very vital in letting us know a couple of things. First of all, drawing up your cash flow statement will tell you exactly what is your liquidity position. Where has money come from? Where has cash come in? Where has cash gone? Very clearly at a glance, you will know which of your activities is taking in a lot of cash. So it's most often, I hear entrepreneurs telling me, Madam, wo to auditor, he knows, no, he will do it. I don't have to do it. But as entrepreneurs, if you have to have the pulse in your hand, and the pulse is the cash flow statement. So you can actually predict your cash flows for the coming year in these three activities. You could also do it as a post-mortem, but preferably when you predict it for the coming year, this will become much more useful in letting you know from where you can get cash, where all cash can come in, where all cash can go, which activity is going to take, what is your liquidity position, and what is going to take in most of your cash. So that is cash flow statement, and it's very, very important that each of us as entrepreneurs understand this. Though it is prepared by accountants, it's very vital that we understand it in our own way. Where are the main things where cash inflows and outflows are happening? Now, there are other ways. We have studied the challenges. We've looked at the cash flow statement, which is one very important thing. But one of the most important or small tools in your hand on which you can control cash, I said one of the challenges is how do you control cash, and how do you know the flows of cash, and how would you know your optimum levels? How do you know you're in a danger level? So there are some small tools. So one of the biggest tools that I can think of is the debtor's velocity, the stock velocity, and the creditor's velocity. These are ratios, and these ratios help us to understand where the cash is and why the cash is coming in late. For example, let's take the first one, the debtor's velocity. The debtor's velocity talks about is a ratio that tells us how fast are we collecting the money from our debtors, or your trade debtors, or your accounts receivable velocity, as you can call it. Now, if you were to take sales per day and you take your average debtor, that is your opening balances of account receivable of the beginning of the period plus the closing balance of your accounts receivable at the end of the period divided by 2, you get your average accounts receivable or debtors. Or even if you just do the closing debtors divided by sales per day, you take your annual sales and divide it by 365 or 360 as the case may be, you take your sales per day and then you divide it, what you get is your debtors velocity. Now this is a very important tool. Let's say, for example, your answer is 44 and you as a norm give your debtors 30 days credit, right? Now very clearly you are self-financing yourself from 30 to 44. So that is a clear 14 days. Remember, you are financing him. Now that is something your system has not prepared for. Your system was prepared to give 30 days of time to your accounts receivable. But in reality, you are doing 44. Now this is a very big indicator. Now you may be under the assumption that out of the 40 accounts that you have, a couple of them give late, that's okay, they have a long-term relationship with them, so it's okay. Some of them you know will not, they become non-paying people, so that small percentage you keep chasing them and chasing them. But it's very important for us to understand where we are, and this helps us to clearly tell that, okay, this is what your system is prepared for and this is what is actually happening. Similarly, the second important one is your stock velocity. You take your average stock and divide it by your cost of goods sold per day. The cost of goods sold is very simple. You take your cost of the goods that you produce. So it is either sales minus your gross profit can be your cost of goods sold. There are many methods by which you can find out the cost of goods sold. So you take the stock and when you divide it by your cost per day, what you get is actually the number of days in which the cash gets locked in terms of stock. Now, if this particular thing, if you are prepared that your stock should move out of your godown in, let's say, 35 days, but actually you find that it's moving at 64 days, then you know for a thing that your stock is moving very sluggishly. So this tool will indicate how fast your stock is moving. Similarly, your creditors velocity helps us, or creditors or your accounts payable velocity will tell you how fast are you paying your vendors. Now, your vendors may give you 30 days, but in your zeal to be good in the eyes of the vendor and in the market, you decide to pay the money in 20 days. Are you getting some sort of a discount for it? Are you getting some sort of leverage for it? Those are the things you have to keep and balance it out before you pay your payments before time, right? Paying on time and paying before time is something that you need to really look at. Paying after time is stretching your norms. That is another thing, that if you have good relationships with your vendors, you could stretch the norms a bit, or you could get a norm, negotiate for a credit period that is very conducive for you. So, in short, these three velocities of knowing what is your current collection velocity, what is your current stock movement velocity, what is your speed at which you pay your vendors. Now, these are the current compared to what your system was prepared for, will tell you exactly what is happening, what is not happening as per the plan. Another very, very important and a handy tool in the hands of the entrepreneur is the cash budget. Now, we all think budget means it's only the government which draws a budget. And of course, we do all draw budget mentally and every time. But what I'm going to tell on I've seen most of the entrepreneurs, they just keep everything in their mind. Everything is there in my mind. But when you put it down in paper, put it in black and white, the scene totally changes. So it's very important for us to understand and prepare a cash budget. Now you can prepare a budget for a year, month, week, predicting the inflows and outflows and their impact on your cash balances. So normally we prepare a cash balance monthly, for 6 months, for 1 year, and then you put all, sometimes when is your payment for your insurance premium, so September or something, you put that, that these salaries have to be paid this every month, when the cash is going to be coming in from your customers, what could be the average cash sales that happen a month, and what is the rent that you have to pay, so on and so forth. So you keep forecasting it on the thing, and you write your opening balance of the month and put in all your inflows. Of course, when you balance it, the closing balance of January, therefore, then becomes the opening balance of cash in February. So like this, we carry forward to each month the closing balance of 1 month to the next month. And the cash budget, therefore, will help you to know whether you have enough money to meet all your expenses. So you may come to know that in September, you have to make a chunk payment, a repayment of your loan or something, but that particular month, you may not be able to meet that cash. So immediately, you know, there is going to be a shortfall. And this, you know, a couple of months before, then it makes you be prepared. Okay, how can I fill in this gap? That is what I was talking to you in my first slide when I said, then there is a gap between your inflows and your outflows. When your outflows exceed your inflows, this deficit, are you prepared? Do you know the sources from where you can take the loan, where you can borrow money and rotate it for me? Please keep these sources ready. One of the golden rules of cash is raise cash when you don't need cash. If you raise cash when you urgently need cash, then you're going to pay in a whole lot of money and you're going to go in for all sorts of negotiations which will actually be in the long run kill you. So therefore, it's better that when you are safe and you're sitting good, that's when you actually look out for sources of cash. How do you raise money and what are the, negotiate your terms so that you know you can tap in and use that money when the time comes. So these are some of the handy tools that we can use to control the cash levels. Now the next couple of slides I'm going to only talk about what are the checklists that you as entrepreneurs need to have regarding your cash flow statements. Well, I put an ABCD checklist so that it will be easier for you guys to remember. Try always to work by taking advances from your customer. Now, this is easier said than done because I met a couple of entrepreneurs who are in the HR business of placements, and they were saying that they only pay after we place this thing. And one of the golden rules of HR is there are so many people that the companies refuse to pay as advance. We do a lot of job search and we try to get them the right candidate, but invariably the money gets paid only after and in fact they say, oh no, our HR department ourselves has found some customer, internally we have pushed up some person, and therefore the entire time spent actually goes for waste. There's so much of time, and time is cash. So therefore it's very important that though your industry may not, try and make it a norm to take some cash from your customer, more for a commitment's sake and also for the fact that you can that much reduce your cash burden. B stands for be vigilant always. Know when your cash levels. Now, it's so easy these days with the bank that every time you go to your ATM or somebody, you use your card, there is always an SMS that tells you. So similarly, try and keep some danger levels, some minimum level from which you have to start looking. Keep this, write it down and make sure that whenever your levels reach this range, you start taking in the activities that you have planned for at this level. Remember the cash tides that happen, just like the waves that keep coming and going and tides which get affected by the moon. Similarly, your cash inflows and outflows are tides, and suddenly you may find that you are sitting on so much of cash and suddenly you find that there is no cash at all, low tide, high tide. And it's all in the vagaries of business. So therefore, be aware that there are going to be cash tides, and how do you prepare yourself for these cash tides is by only predicting what you can do at that point of time. Not react when it happens, but be proactive by thinking, what will I do if this happens? What all should I do? And therefore, be very, very vigilant that you pay your mandatory payments like your tax and other things which have to be paid to the system. Make sure you pay this. One of the biggest thing in the market is if you have not paid your taxes or filed in your income tax returns and your sales tax, these are very things that they always look for. And that is one of your credit rating things too. So be very careful that come what may, make sure you pay your dues to the government and everything on time, and because that's one of the levels of checks they do for credit rating. The third important thing is try and cut your costs. Easier said than done. Making your costs efficient is actually making your processes sleek so that there is not much of cash wastage is very, very important. that you look at your costs and study your costs and be very careful. A penny saved is definitely something that you need to look at. Please keep saving the pennies. Small drops make a mighty ocean, and in the long run you'll find that your system is getting a little more efficient. D stands for design a system for due diligence. Now this is where one of the most important thing is, you could increase your cash inflows by many ways, right? So you could increase your number of customers, or you could increase the number of visits. You could increase the frequency of usage of your product. You could increase the sales volume and not the number of sales, the entire amount. Or you can actually make your processes much more sleeker and save money. In many which ways you can bring in money. But one of the most important ways in which you lose money is when the fact that your customers do not pay you money, right? And that is when you're scared that, these customers are not paying, they have become NPA. So what do you do? So even if you're a small person, hum kya hai, madam, bada companies hai, so they do it. As small startups, why should I be bothered? Please, right from the beginning, right from the time you have a startup, right from the time you decide to start a company, make sure you evolve a system that will do a due diligence. It may be only 3 or 4 questions. What is this customer? What is his name in the market? What is his, how long has he been in the market? So you have a couple of check-in questions, about 10 questions which you ask for each of your customer. However well you know the customer, make it as a system to put that customers into the due diligence sheet. Just about 10 questions about them. That is very important that you keep it. And that once you keep it as a system, then automatically you will see that your collections actually become much better and you will not have much of NPAs. So this is one small thing that every entrepreneur should do, is keep a small checklist about and to know your customer types, right? That is one. Another important thing is have an efficient reporting system. Arey, hamara company mein do hi we are only 2 of us. What is a big reporting we should do? Please make sure every day you have an idea. What is your cash level? What is the expenses for tomorrow? What are the things it's going to be? What is the level that it's going to be tomorrow or in the by end of the week? This should be on the fingertips. And this can happen if you have a report. Keep an Excel sheet, keep writing in it. You don't have to write it in debit, credit and all the forms that you need to think of. Write it in any which way that you want, but make sure you write it in inflows and outflows so that you know what is the level of cash that you have. Keep this as a report and keep putting it in your mobile, because that's the only thing we never forget, is to take your mobile wherever you leave. So therefore, make sure you have this small thing in your notes or a reminder, about the levels. That is very important. Keeping an efficient reporting system about your cash levels and the movement of your cash for the next week or in your week. Another important thing I've already talked to you about is keeping stock of your inventory. Be very vigilant which is your stock, which is slow moving, which is fast moving, which is the costliest stock that you're storing in, and what are the carrying costs of storing such material. So when you are in manufacturing, inventory is one big culprit for locking in cash. So do you want to move in just in time? But sometimes when you move in just in time, if there is any strike or anything, of course these are all abnormal circumstances, but also we need to be prepared that these things can happen. So keeping track of your inventory levels and which is your fast moving inventory is a very important checklist that you have to keep in mind. G stands for good relationship with vendors. Of course, we all we know how to keep good relationships, especially with people who lend you money. But it's not when you only borrow from them, but it's also after you repay them, and you need to keep good relationships. Even if you're not borrowing and if you're just keeping them as earmarked, when I need money, I'll go to this person. Try and develop consciously good relationship with the lenders. Try and keep it a little more on the social level too, so that it will help you in stretching the terms a bit when you are negotiating for a good deal. And H stands for hidden cash. I already told you, please keep a kitty. This has to be dipped in only during emergencies. Now, easier said than done, because we always know that hidden cash is the first cash to go out, but nevertheless, please always tuck in some money for emergencies. This is very, very important. Of course, I stands for incredible ways to increase your revenue. That's the only way cash inflows come in and think. So think of newer ways. Maybe it's through innovative selling methodologies or your promotions, or you please increase your revenue. Maybe find it, your revenue model should be very, very robust. And please re-look at your revenue model. How is the cash coming in? When all it's coming in? At what stage it comes in? Which is your largest revenue spinner? So these are all ways. How can you make it increase? So do you increase the sales? Do you increase the frequency of the usage so that you get more money? Do you get by lending it or by selling it? And what are the ways in which you can go on increasing money, right? So revenue. So do you do any add-ons? Are we providing a service free for some time and then later on charging it? But always find newer and newer ways of raising more money by bringing in more cash, by increasing your revenue, and the ways and means in which you take this revenue. J stands for juggling. And of course, juggling always between your inflows and outflows. Now, some of the very short caps can always be made use of your great plastic money or the credit cards. Entrepreneurs, especially startup guys, need to look at these credit cards a little more happily, because these are going to be really lifesavers. But you should know how to make use of that time that is given. Good for us that recently they've said they're going to increase the credit time on credit cards, so let's look forward for that. But look for ways and always to juggle between. What I'm saying is, keep your strategies ready so that when the gap occurs, you know what to do. So you are not caught unawares. K stands for king. Remember, the king is given the most important things. So as I told you, cash is king, and therefore you need to raise cash even before you need it. Be very, very proactive. Raise money even before you need it. That's when your negotiating terms will be very, very good. L stands for lay a plan. Just because cash will never be there, don't be without laying a plan. Write down the plan. Don't keep a mental plan. Please make sure that these plans are written in black and white. And of course, as I told you, drop your cash budget monthly, weekly, or anything, and try and live to it. In case you cannot live to what you've written in the budget or what you've predicted in the budget, then it's very important that you analyze reasons why there is a vagary between what you have predicted and what has actually happened, and so that you take a lesson and take a leaf out of it. Note it down so that next time it happens, well prepared for it. Surplus or a deficit, always make sure that you manage how to fill in these gaps very effectively. Of course, I could go on till Z, but I thought I'll stop it at the M and spend a little more time on special tips for startups. So startup guys, especially startup entrepreneurs, you find that cash is only flowing out. You're burning cash. Recognize that these are abnormal flows which will exist only for newborns, and therefore it will take you some time to stabilize your cash flows. So in the beginning, you have to recognize and accept. This acceptance that, this money just goes out and nothing comes in is something very, very difficult for entrepreneurs to swallow. That it takes a long time for you to settle. And at this time, you find that, oh God, money is only going, nothing is coming in, and you're bound to feel very demotivated. Please don't. Recognize this. And know that there is a burn rate every month. Know your burn rate. Every month, how much money is going just like that. I have to spend it irrespective of I'm not going to get anything back. Remember, in the beginning, always whenever you predict, okay, keep at least 2 weeks buffer. So if you've given 30 days credit to your customer, make sure that you're going to get this money only, let's say, in 40 or 45 days. Prepare a system, prepare your budget in such a way that you actually are talking about 40 days or 45 days and not 30 days. Though the customer thinks it's 30, you prepare your system for 40 to 45 days. This is something very, very important. Also, make sure that what could be possible emergencies, what are the seasonalities. Now, invariably in the beginning, you are not very much exposed. So you may be having a preconceived notion that this is good season, off season, a peak season, so on and so forth of your industry. you would have done your research, you would have found it. But when it actually happens, you will actually find that whatever you prepare, you're always caught unawares. So anyway, please understand this. Make sure if you haven't, study your industry, look at the seasonality, and make sure you have strategies for these emergencies. One of the most important things that I would always like to tell startups is don't borrow, try and grow as much as possible organically. Now, when you borrow, what happens is you have to pay them interest. There is a cost for this money that you bring in, and sometimes it is not possible for you to pay, and therefore you cut a very sorry figure. So though it's wonderful to talk about borrowing and growing in other people's money, try and grow organically. So that only way to grow organically is when you plow in your own money from your customers. So that's why I keep telling you in the beginning, try and work with your customer advances. Tell them that you're a new company and that you would you could offset it by giving them some extra value, by giving them some extra time, by giving them extra efficiency or something, but tell them that you would like to work on customer advances. And that would probably make them see value because you're giving something plus by taking this advance. Try and maintain happy relationships and always try and stretch terms with your vendors. Pay your mandatory taxes. Keep your eyes always on the cash level. Remember about the cash tag, which I told for any other entrepreneur. For you, it will be a little bit more, and the low tides are much more in your case, so be very aware of that. And remember that your financial statements which are put for your B plan and the cash in your hand are not going to be identical, and that you can live with losses, but you can never live without cash. So get over your fear about even thinking about cash crunch. One of the biggest things I find is, ma'am, thinking about cash. What will I do? There is no cash. Panicking. There is no cash. This all can be overcome if you have strategies laid out. When you are calm and cool, lay out your strategies, write them down, and write down the places you can contact, what you can do, the terms that you can negotiate, etc. So that when the actual cash crunch comes, you can safely look at this. Easier said than done, but being prepared is always better than not being prepared about it at all. Okay, I think I have gone through, so I am ready for questions. So if you have any questions about cash flows, please feel free. Hello?
Thank you, Radhika ji. Hello? Hello, can you hear me?
Yeah.
Yeah. Thank you very much for the... Yeah, it was an interesting session. Yeah. Couple of attendees have questions to us. So should I start with the question answers?
Okay.
Okay. Yeah. Logesh wants to know when do founders start drawing salary and how is that number determined?
Okay. One of the commonest things that entrepreneurs, startup guys is, should I pay myself, right? Normally, I would advise that yes, you should pay yourself. But don't pay yourself the amount that you would have got had you not started the business but had worked in some company. You would have got some X amount of money. Don't pay yourself X. Pay yourself something less than X. But definitely pay yourself something. Because if you don't pay, what happens is you don't take the time and energy and the knowledge that you have put into your organization as a cost. And therefore your costing goes haywire. So it's very vital that I always advise that you make provisions to take money out of your business as salary for yourself. Easier said than done, because you normally, the first thing is if you say, it's okay, I can do without salary. I know you could do without a lot of other, perks, but take some minimal amount. Minimal amount is just minimal, bare minimal, just for survival. That's what I would advise.
Okay. Just 1 minute. Manoj Ranjan wants to know, can you suggest any web tools to manage and plan the plan cash flow? He says he's from corporate hospital industry.
I
yes, think he's
Manoj.
Yeah.
There are tools. Please go to IBM SME Startup Tools. I think it's there also on the NEN website, but The IBM SME Toolkit has a fantastic tool set of tools for managing finance and cash tools and extra, which you can easily, it's like a menu, you can just fill in and get those charts and everything on your fingertips. Please go to that. Just type in IBM SME Toolkit. ICICI Bank members also have that here. Thank you.
Okay, Prince Tanwani wants to know, how can CFS help in a service industry that is IT?
Cash flow statements are useful whether you're IT, non-IT, whether you're high-tech, low-tech, no-tech. Doesn't matter. Any business organization in which there is cash inflows and outflows definitely will find cash flow statement very, very useful, because it right away tells you what is your liquidity position. It will predict what are your needs, whether it is the needs in your investing or financing or your operating. Where do you actually require this? What are the changes that are happening, in terms of in your business itself, can be captured very well in the cash flow statement. And of course, you get a very clear view of what are your capex and your opex, what are the sources from where you've taken money, and whether your debt is more, your equity is more. All these things can be just known only through your cash flow statement. So it's very vital whether you're an IT or a non-IT. It doesn't matter, as long as you are a business concern, cash flow statement is mandatory, must. And as an entrepreneur, forget the dues and the thing that you need to show to the government or to the bank or to your VCs. But as an entrepreneur, your cash flow statement has to be understood by you very, very thoroughly. You don't have to do it in that format, but please understand what it stands for, what it shows, and what is in it for you to understand and take it as a learning from that. Very important. Yes.
So what are the relevant ratios for IT service company? This is being asked by Kunal Bhushare.
Okay. Kunal, see, when it comes to an IT and a service-based company, I think stock turnover ratio is not very useful. More or less the inventory is out. But what would be useful there instead could be the burnout rate. That is where the time it takes for you to actually build your product, the product development stage, the cash spent during the product development stage. That is your burnout rate. That is a very useful tool. And of course, your accounts receivable turnovers and your accounts payable turnovers, these could be very useful for you in service-oriented organizations.
Right. Ravi Ashia wants to know how to cope up with the situation of getting lost, lots of orders and not having enough money to fulfill them without getting advance from customers or taking debt from anybody.
I think you're talking about a very idealistic situation here. You have a lot of orders, you don't have cash, you don't want to take advances from your customer, and you don't want to borrow. Is the question also that he doesn't want to borrow, Meenakshi?
Yes. Without taking any debt from anybody.
Then why? What is the risk that you want to take? What is business? Is taking risks, right? How well you take the risk, how well you take a calculated risk, and you do your is the success of your business. Well, I think that's a very idealistic situation where you have a whole lot of orders, but you don't have. You must be sitting in either sitting on a big pile of cash. Then you can do this, but without borrowing. Then take in a new partner. Maybe you could bring in more equity. That's only possible. But without doing any of these, it's impossible just to meet orders without taking loans. Or the only possibility, if you're not taking a loan, then take in more equity. That's the only answer I can give you, right? Otherwise, it's very difficult. Yes, please.
Yeah. Abhijoy Sarkar wants to know, can there be negative cash flows from change in receivables, say for a manufacturing company, and how?
Can it be negative? Can you repeat the question, Meenakshi?
Yeah. Can there be negative cash flows for a change in receivables in
For
a
change in
manufacturer?
receivables.
Yeah. Negative cash flow from
Repeat that.
change
What is
in,
it?
yeah, change in receivables.
Change in receivables, debtors, okay. Can there be a negative flow?
Cash flow, negative
Obviously, when
cash
the
flow.
debtors. Yeah, so what do you do when your customers do not pay you, right?
Yeah.
And sometimes there could also be a fact that you could have also bought from your customers, and your customers could have bought from you. That could be also resultant account vagaries. In manufacturing, yes, it can happen only in very rare occasional circumstances. The negative cash flow that the debtors and I'm talking about a situation where you and your debtors or you and your customer have a two-way relationship where you are also a customer for your customer and so on and so forth. In such a case, yes, this is a very rare phenomenon. But usually your negative cash flow from your customers, which means that they are not going to give you money, that is your non-performing assets, debtors, is very common. As I understand it, negative cash flows is when your customers do not pay you money, right? And this is very, very common. What do you do with an NPA, right? This is one of the things. How long can you keep them as NPA, right? How long can you say, okay, he's going to give me, he's giving me next month, month after. There are few things that you have to keep in mind to avoid this. One is raise your invoice quickly. Number two, try reminding your customer before due date. Okay, but once you give him a due date and you tell him, okay, this is your due date is coming and I hope to receive the check from you, gentle reminders. And suppose he says, okay, please give me a week's time, I'll pay you the money. In that 1 week, don't badger him by saying, okay, 1 week, you said 1 week, right? You said 1 week, where's the money? The time's over, time's over. Give him that 1 week, and after 1 week, if he does not pay you, that's when you start badgering him for some collections and say, please give this money, etc. But how long you have to recognize that you're going to spend time, waste cash in making calls or going to his office. How much can you put on it? Sometimes the cost of collecting that money only becomes more than what he owes you. So learn to recognize when to put a stop and say no to the customer. But prevention is better than cure. So I would suggest that you do your due diligence before you actually start lending to these customers.
Okay.
Yeah.
Sneha Bharadwaj wants to know, how can we make a note of all these points in an easy manner when working in busy schedule and making a gist out of it? Like, basically to talk about the debtors, the cash flow and the managing the cash flow.
I didn't get the question. How do you keep track of all cash?
Yeah.
Is that okay?
Yeah.
Close?
Yeah.
Schedule, right?
Yeah.
Okay. Neha, on a lighter note, how fast are you on your SMS and on your phone? Yeah. So you guys are so fast. I presume that you're one of the youngsters and therefore you must be very fast. At least I'm so sure you must be faster than me. I think the mobile today, the smartphones are so smart and making a very effective use of keeping track of it just in notes. See, there is no need for you to actually keep it in a big format. Keep it as reminders. Put it there in your notes. And then later on when you're at more leisure, or once a week or something, set aside a time wherein you transfer all this into a proper record so that you will be able to make some sense out of it. So that's the advice I can give you. Yes, make use of your mobile phone. Yes.
Okay. Saumik Saha wants to know, most of the time purchases are made in cash or cash discount. For cash discount, is there any harm or what should be our focus other than CD? Other than cash discount?
Well, Saumik, what you're saying is absolutely true. I know most of the entrepreneurs prefer to buy cash, purchases in cash because of the cash discounts. And also they feel that, it's a better way to bargain and you are more happier that way. A lot of them do that, but these are the guys who always do cash sales too. So they are very clear that their credit sales would be very minimal and their cash sales will be definitely more. Such type of people definitely go in for cash purchases. Yes, on a good note, yes, it's always better to buy cash purchases on cash. Buy purchases for cash terms rather than credit terms, and therefore make use of your cash discounts which you get. But also the question is, how much is the cash discount are you getting? Is it worth the while, or is it better to take on credit and use that amount of cash, that much of money to rotate in that time period? You need to do a cost benefit analysis. Is the cash discounts better, or is the rotation of cash for this credit period that he's offering much valuable to you? These are the two things which you need to compare before you take a decision. Thank you. Meenakshi, next question.
Yeah, and the next question is by Hari Venkata. He wants to know, how do we deal with booking agents in travel industry to expect credit and never pay, and they never pay on time?
Pardon? Can you repeat the question again, Meenakshi?
How do an entrepreneur deal with booking agents in travel industry who expect credit and they never pay on time?
So basically you're again asking, what do I do when the customer does not pay on time but expects that you give him on credit, right?
Yeah.
So one of the important things that as a business, you cannot do away with credit sales. You have to, in order to develop your business, you need to give a credit rate, a credit period to your customer. Now the question is, how much of credit period can you give? Maybe you can look at the levels of businesses that are being done by this customer. You definitely also need to do your due diligence on them, and based on that also give them the credit. So be prepared by doing a whole lot of research on your big customers and look at their past history or look at their market history before you extend credit. Now, to such people, giving them credit will help your business. But it so happens that, invariably because of the fact that they're bringing in more business, we feel so good that the sales are advancing, and so we give left and right to customers and say, oh yeah, okay, give these agents. They're bringing you business and they are registered agents of yours, and therefore you think that they will give the money. Maybe here you could, very clearly as a policy, when you get into your agent relationship, principal agent relationship, lay down the norms in your policy that what would be the mandatory days by which they pay the money, or what could be the rate of interest that they need to pay once this doesn't, the time lapses. Now these are the things that very clearly, while you draw up the agreement between you two, if you are very clear in your policy of collections, I think that would go a long way to help your business.
Right. Geeta Devi wants to know, what is CRS?
Cash reserves.
Yeah, I think so.
Yeah.
So do you want to explain a little bit on it?
We're talking about cash reserves and where are the areas at which you keep your cash reserves, and that is what we mean by cash reserves.
Okay.
So where all are we keeping cash? How much cash? Do you set aside a specific cash reserve because you know that, for example, that taxes are going to happen, so you set aside a separate cash reserve for your taxes and say, okay, this is going to be used for this purpose, or you set up a general reserve for general expenses. So reserves are basically pools which you keep aside either specific or for general purposes.
Right. Madhuri Ruya wants to know, she runs a gym and it's a service industry, and she wants to know any ideas for her to manage, how to manage cash flows.
Madhuri, hi, and definitely getting your customers, you are in a service where You get the cash well before you give your services. So are you collecting the money before they use the gym or after they use the gym? So invariably, most of the gyms collect money before they actually start. So 1 month before you collect your rent for the usage. So you also look at ways and means in which you can increase this revenue through various things, either by selling. You have different revenue streams in your gym, right? So look at newer ways in which you can increase your cash flows by having newer machines perhaps, or newer workouts, or innovative juices, or things in which can increase your streams. So there are different revenue streams your business in the gym has. You could get your monthly things for leasing out the thing. You could get special helpers or personalized assistance. That could be one sort of a revenue stream for you. So try and increase the number of revenues streams in your business, and that would probably increase your cash in coming into your system.
Right.
Yes,
Radhika ji, Sandeep Kumar wants to know how to control cash flow in e-commerce industry. How often should they update their financial model?
In the e-commerce, it's very difficult because if you are like as big as, let's say, an Amazon or a Flipkart or any of such thing, you need to have a lot of cash locked in terms of your warehouse where you keep a whole lot of things. So there, the cash which is locked in terms of your inventory, locked in terms of your retail inventory, plays a very, very huge role. So the amount of cash levels that you need to maintain is very, very high in e-commerce. But if you are in something wherein you are only being a facilitator and you are not becoming a merchant but rather a facilitator, then in such a case, the cash amount level need not be very high because you are being more a facilitator. Like for example, where the sale e-commerce happens in like eBay or something like that, where you actually not investing in inventory, but you're only facilitating the exchange of goods. So there the level of cash that you need to keep need not be very high. So depending on what sort of an e-commerce business you are in, definitely the ways at which the cash levels will depend on.
Right.
Yes.
So Radhika ji, there are lots more questions. Due to time constraint, we'll be stopping here. However, attendees, if you have any more doubts, you can definitely give us a buzz on the email ID provided. We'll try and get your queries sorted. If you found this session interesting, tweet us at NEN India, and recorded version of this webinar will be available at youtube.com/user/eClub NEN Online by tomorrow. We're glad that the questions kept coming in, and the presentation recording of the session will be uploaded by tomorrow evening. The next NEN webinar will be conducted on 25th of June on business networking for entrepreneurs and its pros and cons. Entrepreneurs, as I've written to you earlier on the chat box, please note that you qualify to NEN Mentoring Clinic directly, conducted on 4th of July. Please contact or write to me at Meenakshi.Mohanty, which is MINAKSHI.MOHANTY at nenglobal.org to get an invite. Mentoring Clinic is an online session on 90 minutes where two case study entrepreneurs with topic related real-time problems present their cases, and a panel of experts discuss and give advice to the entrepreneur with the solutions. And attendees and talk about the attendee questions regarding the same. It's an invite-only event. If you're interested, you can apply through our website, www.nenglobal.org. The application is for attending, and if you want to be a part of the case study entrepreneur, or you want to be a case study entrepreneur, write to us at the above mentioned email ID with your business idea, your business explanation, vision, mission, and your key challenges that you would like to discuss with the panel of experts. And we can take up individual cases accordingly. And also, so the upcoming mentoring clinic is on 4th of July on the topic risk management, minimizing risk with maximizing opportunity. Thank you so much for this very interesting session, Radhika ji. Thank you all our attendees for participating in the webinar, and have a nice evening. Thank you all.